This is frightening. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, experts are indicating that a major economy is going to contract as much as Russia's economy this year. And if we were to see a major economy contract that much, it would have major implications on the global economy and likely pull the rest of the world down with it. We've also got a report out today that indicates the Fed might not be done with this tightening cycle, and the U.S. manufacturing sector, well, things there are getting worse. Let's over to CNBC, where we picked today's story up. With the UK recession will be almost as deep as that of Russia, economists predict. Now, you can imagine, we know Russia's economy has severely contracted. Can you imagine if this happened to the United Kingdom, what that would mean for the rest of the world? Moscow, let's go over to Russia now. Russia's economy shrank 3.7% year on year in the third quarter of 2022. So let's try to put some perspective here on what's going on, because that was an improvement over the previously reported 4% contraction, which is still very severe. After growing 3.5% in the first quarter, this would be for 2022. The Russian economy has now slipped into a recession with a 4.1% and a 3.7% contraction in two subsequent quarters. By any definition, that's a recession. And as you'll look at in a moment, I want to put this in perspective to the U.S. economy, because I want you to understand just how bad Russia's economy contracted, because then we're going to look at what the predictions are for 2023 and then what that means for the United Kingdom. So here you can see in this chart, this is the U.S. gross domestic product. And what I want you to see, there's a couple things. First of all, contractions, where you see the blue below the black line, the horizontal line, they're very rare. In fact, most recessions are just a slowdown in economic growth. You'll note here the great financial crisis, this was a 3% contraction followed by another 3% contraction. So you go back to Russia's data, and what do we see there? A 4.1 and a 3.7, making this worse, in terms of Russia's perspective than the great financial crisis here. So let's look again, because I want to point out that when we were in the pandemic, even when everything was shut down, the economy still only contracted by 7.5%. So this is pretty interesting. Now let's look at what's going on with the UK. In its 2023 macro outlook, Goldman Sachs forecast a 1.2% contraction in UK real GDP over the course of this year. Now, well below other G10 economies. This is set to be followed by a 0.9% expansion in 2024. So you think about, when we looked at that U.S. chart, and a minus 1.2% certainly would be interesting enough, because it doesn't happen very often. But if we put it in context to, say, the great financial crisis, well, it's not as severe. In fact, nowhere near as severe. But for a major economy like the UK or the US or any other major economy to actually contract, well, that is a really big deal. The figures place Britain only fractionally ahead of Russia, which the banks project will see a minus 1.3% contraction in 2023 as it continues to wage war in Ukraine and weather punitive economic sanctions from the Western powers. This will be followed by a 1.8% expansion in 2024, according to Goldman. So what you're hearing here is some parts of the world are starting to suggest we'll have a soft landing. You're hearing UK will have, maybe more of a harder landing. But notably, what do you see in their predictions is this is going to go and happen and then go away, because the economy is going to actually get better. The global economy is going to get better, they're saying. And you look at Russia and you see from the depths of where it's at now, what Goldman's saying is, hey, their economy is about to improve. But is this really what we're going to see out of the UK? Well, the euro area and the UK are both already in a recession, according to Goldman chief economist, since both have endured a much bigger and more drawn-down increase in household energy bills that will drive inflation to higher peaks than seen elsewhere. When we talked about on the show why the energy sector is so important, because it's something that you just can't adjust to quickly. So you think of it from a monthly budget perspective. You've got a household, and then you have energy prices spike. Now, what do they have to do? Well, they have almost no choice. And yes, they can cut back on their energy usage, but because prices go up for fuel and electricity and gas, well, what does that mean? Their prices, their budget is going to have a larger allocation to energy, leaving less money to discretionary spending. And that's why we see spikes in energy prices tend to lead to a contraction in the economy. And now let's take a look at this chart, because I want you to see the correlation between the energy sector and US GDP, and you'll see exactly why this is going to happen in the UK. So here we can see in red now we have crude oil prices shown on a year-over-year rate of change. And what we can note here, you see a spike of it in the 80s, and then that leads to an eventual slowdown in the economy. Here you can see going in the dot-com bubble, a big spike in energy, and again leads to an economic slowdown. You see at the great financial crisis, it probably made it worse than it should have been. Again, you see what we almost had was a double-dip recession. Energy prices spiked again, but luckily came down. You see going into the pandemic, when we were going to face a global recession anyways, you can see the key driver was a spike in energy prices. It's happening again. And notice the relationship where energy prices head. Well, the economy soon follows. And I think that's something a lot of people aren't getting. Now, another thing people aren't getting is why did the stock market sell off that much? Is because they don't understand machine positioning. Again, we look at our CTA-Timer Pro report, give us an idea how machines are positioned. When we see right now in the S&P, they're 15% long. Now the NASDAQ, they're 100% short. So it makes sense. If you knew how the machines were positioned, you'd probably be saying the NASDAQ is almost bottoming, and you're wondering why the S&P isn't dumping. Well, because the machines aren't unwinding. And why aren't bonds selling off more? Well, the machines, they're not backing off. Link in the description below, $20 a month, and you know how the machines are looking at the market. In turn, high inflation is set to weigh on real income, consumption, and industrial production. We forecast further declines in real income of 1.5% in the euro area through the first quarter of 2023, and 3%, that's staggering, a 3% decline in real income for the UK through the second quarter of 2023 before a pickup in the second half. And of course, we know and we talk about on the show that real income is really critical because it's inflation adjusted income is what that means. And if people have less money to spend, well, that means they're going to consume less. Again, this all kind of points back to one thing: discretionary spending. The less money people have for it, well, the economy naturally must slow. And that's why when we get into the manufacturing piece in part of today's show, you're going to see this all playing out. Households are expected to rein in spending on discretionary items, there you go, in 2023 in response to the squeeze on income. What a shocker. As consumers cut back on spending, we anticipate a sharp reduction in non-essential categories of spend by those households most affected by the rise in energy and food costs, including spending on eating out and entertainment. So you could almost already predict, what does this mean for inflation? It means it comes down. What does this mean for new order growth and manufacturing sector? It comes down. So you start to see what these indicators are when real personal income, again, inflation adjusted income falls, well, the rest of the economy slows. But one part of the U.S. economy isn't showing signs of slowing, and that could give the Fed reason, perhaps in February, to hike another time. Job openings hold strong despite rate hikes as manufacturing in contraction. The job openings and labor turnover survey for the month showed available positions at 10.46 million, down fractionally from October's total and above the 10 million forecast by FactSet. The JOLTS survey is closely watched by Federal Reserve officials for signs of labor market slack. Now, we know this is a key thing for the Fed because it was Janet Yellen, remember, former Fed chair. She loved the JOLTS survey because why does the Fed want to see fewer job openings? Because what they want to do is they don't want people to realize they can change jobs and get a raise. So if there's lots of job openings, it leads to wage pressure to the upside. And of course, the Fed believes there's a wage price spiral that will keep inflation up. So from the Fed's perspective, they want to see this head down, but this is really highly correlated to the stock market, which we'll see in a moment. On the jobs front, the JOLTS report showed a slight decrease in hiring and a bit of an increase in layoffs. However, the report had little indication of a substantial labor market softening. And here you can see in the charts when we overlay job openings with the total U.S. stock market, or Wilshire 5000, you'll know what we should expect to see. As the market goes sideways, the JOLTS tends to follow it with about a 2-month lag, suggesting the job openings should continue to hang out here. But does that mean, if we look at the factory sector, where it's headed, what does that mean for job openings? Well, it means they're probably coming down. As we head over to the manufacturing PMI, this from the Institute of Supply Management, now at 48.4. Now remember, under 50 is a contraction. When you get below 45, you are now moving into a severe contraction. Let's look at the headlines before we get into the data. New orders and production contracting, not inflationary, not growth. That is slowing. Backlogs, this is your inflation component, big one, contracting. So that means they're working through their backlog. Supplier deliveries, these are faster, meaning things are getting to factories quicker. That's not inflationary. Raw material inventories growing, not inflationary. Customer inventories remain too low, but I doubt that'll last forever. Prices decreasing, that also is not inflationary. Exports and imports, that's contracting. And we know when exports and imports contract, that means the economy is contracting. Let's dig into this report a little bit, because I want you to see, look at the new orders at 45. So we're about to start entering a severe zone of contraction. How about production? So you're talking production at the factory level is now slightly contracting. How about employment? They're holding steady. And if you think about why they're doing this, it's because they just hired on a bunch of people and trained them. So they don't want to let them go yet. But if this doesn't turn around in a matter of a couple months, watch this employment number to head a lot lower. How about supplier deliveries? We know they're improving. Customer inventories are still too low, but look at inventories at factories now are starting to build. That's again a sign that they're going to have to slow production down and lower prices. But look at prices. They're contracting at 39. This is really, decreasing at a faster rate. There's your inflation component going away. There's your interest rates going down. You see backlog of orders contracting. And here we can see when we take the current prices paid from the Philly Fed. So this is looking at that price component, overlay the CPI. Notice how that blue line leads the CPI lower most of the time. Here you see it heading down. It's telling us consumer prices are headed down. What does that mean for interest rates? I know the market, a lot of people think rates go higher, but this data says rates going down. And there's only a couple instances you'll notice that the blue line, again, leading interest rates in both directions. But what do we see? There are periods where the prices paid at sub-index heads lower and interest rates are still driving higher. And what happens? They eventually come rapidly crashing down. You see here again, prices paid trending lower, rates heading higher. And the next thing you know, rates come down. We see the same dynamic here, suggesting that rates are indeed coming down. And this is particularly the case if you see the UK is going to head into recession. What does that mean for consumer prices? They're going to go down. Demand's going to go down. Rates are going to go down. And that means job openings that the Fed looks at now will eventually go down. And unless the manufacturing sector turns around soon, well, we're going to see more downward pressure on that path to what the Fed is hoping is a soft landing. But as we know, maybe later this year could be much worse. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.